I honestly can't believe we're discussing an Intel super cycle in 2026. It's wild. They just printed their fastest growth in over a decade, but at the exact same time, the headline GAAP earnings look like an absolute crater. Welcome to Earnings Unscripted. Today's July 23rd, and we're unpacking the second quarter tape for Intel, ticker INTC.
Yeah, it's quite a reversal. Everyone spent last year reading the obituary for this company. Now they just dropped $16.1 billion in total revenue. That's up 25% year over year. The AI server demand isn't just a GPU story anymore. It's spilling directly into back-end CPUs, and that's basically bailing them out of a very soft PC market.
Right, they're riding the coattails there. But what genuinely caught my eye was the operational discipline this time. Remember last quarter when David Zinsner, the CFO, promised he was going to be a dog with a bone about fixing margins?
I do, and I was highly skeptical. But they actually delivered. Non-GAAP gross margins hit almost 42%, so comfortably in the 40s, and they didn't pull that off with accounting tricks.
No, they didn't. Actually, my favorite detail in the call was how they handled their stranded inventory. So they realized they didn't have all the right memory parts to finish complete matching sets for their client PC chips. I feel like the old Intel would have just thrown money at finishing those chips anyway, just to pump up volume metrics.
Right, force them out the door at a discount.
Exactly. But this time, they literally just left them stranded. They ate the write-down instead of chasing bad revenue.
Well, they finally chose economic reality over vanity. The street clearly bought the overall setup heading into the print. The stock trended up for months, spiked hard after hours on the revenue beat, but then it totally lost steam during the actual call. It drifted down to close the extended session around $104.
That's exactly why trading on extended hours noise is completely reckless. It's fascinating for us to watch the street misread these filings live, but keep in mind, our analysis here is strictly personal opinion and never financial advice. So wait, why did it fade so heavily while management was talking?
Because once people read past the adjusted revenue beat, they slammed into a massive unadjusted net loss. We're talking an $11 billion GAAP deficit. It's a non-cash accounting distortion, but a number that huge absolutely breaks valuation models.
Okay, and that ties perfectly to what we flagged last quarter about the U.S. government holding those CHIPS Act warrants. I need to know exactly how a federal escrow account just cratered their entire income statement.
So this comes down to the Secure Enclave program. Intel holds these CHIPS Act escrowed shares, which legally act like a derivative liability on their balance sheet.
Wait, let me make sure I'm following this. The government gave them funding, and because of some legal strings attached to that escrow, Intel suddenly had to cut a $12 billion penalty check?
Actually, no. And that's the wild part. It's strictly a paper loss. Because the market value of the underlying assets fluctuated, standard accounting rules basically forced them to reprice the derivative. They booked a $12.5 billion mark-to-market charge, but cash didn't actually leave the building.
Okay. Wow, that's just an incredibly brutal accounting quirk. So if you look past that paperwork crater, the actual operating business is humming, right?
Right. Their non-GAAP net income was comfortably over $2 billion. But honestly, the non-cash noise isn't what matters here. The capital they're voluntarily pushing out the door is the real story.
You're talking about the foundry build-out, because I saw they cranked up their capital expenditure target again, didn't they?
Yes, and it's a massive commitment. CFO David Zinsner was dead clear on the call. Quote, "Due to strong customer demand signals, we're raising our outlook for 2026 and now expect our CapEx to be more than $20 billion.
That's a huge swing. Everyone was terrified they'd have to delay the 14A process node, but you don't commit $20 billion in front-end cash unless you've got absolute locked-in customer buy-in.
Right. Well, they passed they passed an internal gauntlet first. Bhutan basically set a trap for his engineering teams. He established a very tough schedule, demanding they yield complex memory cells with low defects before he'd even authorize the 2028 high-volume ramp.
And they cleared it?
They cleared every metric ahead of schedule. That gave leadership the unvarnished confidence to start buying the 14A tooling.
Okay, so the silicon's working, the tools are arriving, and demand's apparently real. But there's a glaring bottleneck here, right?
Always. The silicon dies are yielding beautifully, but the advanced packaging, specifically substrates, remains a brutal choke point. Supply linearity is heavily skewed toward the end of the third quarter and into the fourth.
Which means if that substrate supply chain hiccups even slightly in December, does all that back half server revenue just get trapped until next year?
It leaves them facing a steep logistical climb. The data center demand's huge, but because of those substrate constraints we discussed earlier, their supply is incredibly backloaded. They've got to nail the packaging at the very end of the year to actually recognize the revenue.
Okay, wait, so it's not a demand problem at all. It's literally just a race against their own assembly line? If a packaging facility blinks in November, they miss the year?
Exactly. But management seems pretty confident they can clear the backlog. They're guiding Q3 revenue somewhere between $15.8 and $16.8 billion.
Which implies they're really counting on that server momentum to carry them, right? Because client PCs are supposedly entering a, what do they call it? A sub-seasonal back half?
Right. PC consumption softening, but AI servers are bridging the gap. That's the whole reason they feel comfortable raising this year's CapEx to more than $20 billion. They see the firm buy-in. Like David Zinsner said on the call, until we really know that we've got the customers, we don't want to put significant amount of capital.
It's honestly a completely different Intel than we looked at just a few quarters ago. They used to sound like they were just trying to survive. Now they're laying down these massive bets and forcing the entire supply chain to keep up.
Yeah. The operational disciplines finally matching the engineering ambition. If they can actually get those advanced packages out the door by Q4, it's going to be a fascinating finish to 2026.
No pressure at all for the substrate engineers, right? All right, that's the Intel story this quarter. Massive AI demand, some wildly distorted accounting on paper, and a literal race against the clock for the holidays. Thanks for unpacking it with me.
Always a pleasure. Catch you later.
Hitting follow wherever you're listening is the best way to catch these breakdowns the moment they drop. And just for total transparency, we're actually synthetic voices hosting a completely AI-written experiment that goes straight from Intel's raw SEC filings to your feed on the exact same day. We'd love to hear what ticker you're watching next, so drop us a line at earningsunscripted@datamadness.ca or find us on X through the show notes.
See you out there.